Hey people, happy Friday. Today I'm bringing you Friday finance hacks and talking about offset versus redraw. This is a huge mistake that I see people make that can end up costing them tens of thousands of dollars every single year if you get it wrong. Now the rules get a little tricky, a little confusing, but in Australia, under the tax laws, there is a difference between how the tax office considers offset accounts versus redraws when it comes to deductible interest expenses. So essentially, when you pay interest expenses on borrowings for investment purposes, you manage to get a nice tax deduction which can offset the amount of tax that you pay and boost your tax refund at tax time. But where people go wrong with this is that with property, if you own your own home, i.e. the property that you live in is not an investment and it's your home, you unfortunately don't get a deduction for that interest payment. And because property is expensive in Australia and getting to your dream home often takes a little bit of work, a lot of people will buy stepping stone properties. And the common scenario where people go wrong is that they buy a home, they think they're doing the right thing, and they're living in the property, they pay down as much as they can on the debt, and then after a while they realize that they want a bit more space, or they want to buy the next property on their pathway to their dream home, but they've built a bit of an attachment to the property. It might be a good investment, you bought smart the first time, so why not keep that property? Property's expensive to buy and sell, so you want to hold on to it. But if you pay down your mortgage and then redraw against the equity in that property to buy your next home that you live in, because the purpose of that borrowing is to buy another home and not for an investment, that debt is not deductible. And then the debt that's on the original property is lower because you paid it down. That's now an investment, so the debt is deductible. But the fact that you paid down the debt means the interest expense for that property is lower, and therefore your tax deduction is lower. Now, how you can get this right is that if you use an offset account instead of a redraw, you can park all of your savings in the offset account. It reduces the interest that you pay on your home while you're living in there. But then when you withdraw the money from your offset account, the borrowing has never actually reduced, so the interest payments go back up for that property, which is now an investment, and you get a nice sweet tax deduction. So as I say, the rules get a little complex, but it pays to get this right. So make sure that you take the time to understand that and have the right strategy in place so that you maximize the after-tax return that you get, and accelerate how quickly you get ahead. Hope you find that one helpful.